And welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread, and today is our 200th show. That's right, 200 shows have come and gone since we began this journey almost 2 years ago now. It's been pretty amazing to stand by and watch the results, just to sit back and see the comments on the various channels as the podcast is aired on Stitcher, Spotify, iTunes, iHeartRadio. I mean, it goes out on a lot of different locations. And to receive your feedback, whether it be through Twitter, you can find me at Justin Goodbread, or on LinkedIn. Man, people have reached out on LinkedIn a lot about the podcast. On Facebook at Financially Simple. You can find me on Instagram at Justin Goodbread on Instagram. Even on Pinterest now, we've actually had some content hit Pinterest due to some graphics that we've developed, and folks are liking the content on Pinterest at this point. So I'm honored that you're stuck with me through 200 some odd episodes. You know, many podcast hosts would take time to reminisce about their journey to the 200th show. But I'm not like most podcast hosts. For one, I can't speak, it seems like. But no, seriously, I'm going to stick to the series that we're working through. And after we finish up the series, we'll go through and talk about some of the highlights that I've seen in the podcast. But right now, we're dealing with personal finances for us business owners. Now, if you will remember, just as a little bit of reminiscing here, the first 50, 60, 70 podcasts, we dealt with building a business to sell. Then the next 100 or so podcasts, we dealt with actually growing the value of our companies and why value matters so much. And then for the last 20, 30, 40 episodes, we've been dealing with personal finances for us business owners. Hindsight, I probably should have flipped it around, but nonetheless, here we are. We've been in our personal finances, though. We've gone through cash flow and risk management, and now we're dealing with investing. Today, I want to take a time out. In the Bible, it would have a Selah, just rest for a moment, just a Selah moment, and look back on some statistics. With the idea of today's title being, why should a business owner invest in assets outside of our businesses? Why should we? Why should we business owners take money from our business and put it in assets outside of our business? I got to tell you, if you've heard me speak anywhere, you'll know real fast that I am not a fan of corporate Wall Street. Corporate Wall Street drives me batty. I think they hide so many things from the average person with fees, et cetera, et cetera. And it just drives me batty. The other thing is that the Wall Street types that typically are running around trying to gain our accounts, investment accounts, so to speak, they don't understand business. They think they own almost my money. I've probably told the story of whenever I was a kid, my brother and I were making very, very good money through our business, and I went to see a financial guy. He was at a popular firm, one of those two-name companies that most of us would recognize, and walked in making well over $100,000 a year in income. And he says to me, "When you're more successful, come back and see me." Now, I got to tell you, that chapped my hide, as my dad would say. That did not set well with me. I was like, oh, man, you don't get it, buddy. I'm 18 years old. I'm rocking the world. I want to put some money and, quote, invest it. This idea that I have to be beholden to this person in a suit, especially. By the way, if you're looking at me on YouTube, we air all these videos on YouTube. You'll see I'm wearing I call it my tablecloth shirt today. Looks like a tablecloth. I love plaids. It don't look like I'm a fat blob in plaids. I'm like really wide, very short. So whenever you're really wide like me and very short, you look like a roly-poly or an Oompa Loompa off Willy Wonka in the Chocolate Factory, so I wear plaids. It kind of hides it some. I cannot wear horizontal stripes. I look like a fat zebra walking through. Anyways, I was pretty frustrated with this guy who would have the audacity to tell me that I need to come back when I'm more successful. But I got to tell you, I hear that spiel more now than I did earlier in my career. You see, most of the clients that I've come to serve are business owners. And as business owners, this idea that we should take a substantial portion of our money out of our business and give it to some Wall Street guy, gal, whoever, to invest our monies for us, just mesmerizing to me. I realize that I can make more money in my business with those funds than the stock market can make in a most of the time proportional same amount of period of time. I get it. We run all sorts of calculations at tax time. We're actually in our tax time. As I record this, it is mid-October 2019. We're headed off to a conference on advanced tax planning, my team and I, a couple of our CFPs and I, and we're coming back and jumping in the middle of tax planning. So November, December is our tax planning time for our business owners. We're coming back and we're going to deal with that. And I get that we can make more money in our business. But I want to pause the narrative, and I want to approach it from not the Wall Street Journal or the Wall Street type of person, that suit and tie, who's telling us to give them all their money and shut up and leave them alone. We're just going to totally flat out trust them with our money. It's not who I am, so you probably isn't you, because we're business owners. Early in the podcast, I dealt with the statistics of liquidating or selling a business. And I wanted to revisit that today, just to refresh our mind as to why we should invest outside of our business. So these statistics comes from the Exit Planning Institute and a number of other locations. I wrote about this in my book, The Ultimate Sale. By the way, The Ultimate Sale is available on Amazon, both in written format and in audible format. So yes, you probably don't get enough of me here on the podcast, so you can listen to me for 6 hours straight. Talk about read the book, which, by the way, I think I'd rather stick a fork in my eye as opposed to do that again in my life, but I did it. Here's some statistics I want you to think about. There are currently 3 types of markets. You have 5.6 million companies in the micro market. The micro market, that's where my business sits. It has less than $5 million or $10 million in sales or revenue. 5 to 10 is going to vary depending on which study you read, so I'm going to use double numbers here sometimes. But the micro market is less than $5 or $10 million in money. I would say that the majority of the businesses in the United States at 5.6 million are in the micro market. Now, the middle market would be 5 to 10 million to $100 million in annual revenue. There are roughly 351,000 businesses in the middle market at this point. So the middle market was between $5 to $10 million of annual revenue up to $100 million. And then you've got about 21,000 companies in that $100 million and plus. Those are your McDonald's. Those are your Chick-fil-A's. Those are your, I don't know why I'm thinking about food right now. I must be hungry. But I would probably need to put like Papa John's, Papa Murphy's, some of the Papas out there, right, with pizza. Interestingly enough, here's an EPI stat. 80% of businesses never sell. 80%. 80%. 80%. That means out of the 10 people who just heard that, 8 of your businesses will not sell. Well, Justin, my business will sell. I challenge you to go back and read that overconfidence study that I wrote about in last podcast series, or last one talking about timing the market. It's an interesting and fascinating study about how overconfident we are. Perhaps you there was another study I read years ago that talked about if you ask a group of people, are they better than average drivers, 70 to 80% of them will raise their hand, which is improbable. 70 to 80% of people cannot be better than average. That's just improbable. But 80% of businesses never sell. Think about that. Here's the scary part. 80% of business owners' net worth, our net worth, the money that we have, is actually tied up in our business. Whether it be through business valuation, whether it be through the equity, the assets we have in our business, 80% of our net worth is tied up in our business. So think about this. If you're worth $1 million today, as many of us are, worth $1 million or greater. If you're worth $1 million today at 80% of your business, 800,000 of it is tied up in your business. That only leaves $200,000. And I'm certain that that's going to get a portion of that $200,000, that 20% of your net worth, majority is probably your residence, your house. Most business owners don't have liquid assets. Here's some interesting numbers for you. Currently, there's 351,000 businesses in the United States which earn between $5 million and $100 million of assets. Let's call that middle market. Of those 351,000, 250,000 of them are business owners who are going to try and sell their business in the next 10 to 15 years. That's almost 3/4, 75% roughly, are going to try to sell their business. If 250,000 are going to try to sell within the next 10 to 15 years, only 25,000, so 10% of them, will be deemed market ready, ready for the market to even look at. Think about that. Out of the 351,000 middle market businesses, only 25,000 will be deemed market ready, just to be positioned where someone can look at. I wish I had one of my broker friends on here who sells micro businesses. He tells me, Justin, his number is 9 out of 10. It's not a statistical number. It's a number that he fielded in a conversation. He said, Justin, 9 out of 10 businesses that we meet with are not ready to sell. They don't have a clue on what it takes to sell. This study shows that 75% of the businesses are not ready to sell. But of those 25 that are deemed market ready, roughly only 60%, 15,000 will actually sell. And of those 15,000 that actually sell, only 7,500 will actually sell without concessions. In other words, they'll sell for what the owner believes they're worth. Friends, that's 3% roughly of businesses that are eligible to sell for what the owner thinks they're worth. So let me ask you the question. If every single penny of our dollars that we make are poured back into an asset, which we only have a likelihood of 3% chance of selling, why in the world do we continue to pour back all of our money into our business and not create an alternative? So today's title is called, Why Should Business Owners Invest Assets Outside of Their Business? Simply put, you need a plan B. You need a plan B. I get it. Look, I've sold 3 businesses. I own 3 and I'm getting ready to start a 4th. I get it. I know how successful we can make. I would not be worth 7 figures if I did not have businesses in my life. But what if I'm busting it at age 40 this year for the next 25 years and I fail to create a plan B, and all 4 of my current businesses, and those I will probably more than likely start in the future, all 4 of them fail? Where will I be? I'll tell you where I'll be. I'll be like most business owners who are broke or are having to work to support their lifestyle, and they never, ever, ever achieve that dream that they set out years earlier. They become enslaved in their business. They don't travel the world. They don't spend time with their family. Their business has become their God. So why do we need to invest outside of our business? Because you need a plan B. I'm of the opinion that you should pay yourself first. If I may quote The Richest Man in Babylon, which is one of my favorite books, if I may quote that book, pay yourself first so that your business sale or your business exit, whatever you do, only modifies and enhances your life plan. Create a plan B. Right now we have a lot of chickens. We have a lot of chickens on the farm. I'm in the process of building Miss Emily a new chicken house. I don't like debt. Most people know that. That's one of the things that I love about Dave Ramsey. I don't believe we should have individual debt. Business debt I'm okay with. I don't like individual debt. So I'm saving cash and I'm building this thing slowly. As we're building the chicken house, we get a ton of eggs. In fact, during the summer times, it was not uncommon for us to get 60 eggs a day during the summertime. Our Jude, my Jude, I should say, who is now 8 years old, just had a birthday not too long ago. It is his job every evening to go and collect the eggs. So he takes out and he collects the eggs. Now, we have an egg collecting basket so that if something happens, the water, the slime, whatever it is, out of the eggs or the slobber, whatever it is, can come right out of the basket. We have an egg collecting basket. One day, not too long ago, little Jude was focused ever so diligently on collecting his eggs and coming back with his wares or his collection, that he missed the water hose. And yep, you can guess it. He tripped over the water hose and his collection of eggs shattered. All of the eggs busted. Poor fella. He was so embarrassed. He was so distraught. But he learned a story at that point that if he had 2 baskets, maybe, just maybe, when catastrophic water hoses come out of the road and try to trip you as an 8-year-old who's trying to conquer the jungle of the grass yard that we live in sometimes, then maybe, just maybe, you won't lose all of your eggs. The same story is true for you and I. We must place our eggs, our wares, our investments, our cash in more than one asset class. We must. And our business is often a good one, but it also can leave us destitute. Think about it. Remember, 3% of businesses actually sell for what the owners think they're worth. And I'll leave you with one last point here. As you're building your investments, we can do something with investments that are not invested back into the company that we can't do as efficiently with investments that we try to invest in the company. Let's pretend for this example that we can invest our money into our retirement account. So let's assume, for example, that you're a business owner and you've already set up your profit sharing safe harbor, cash balance 401k. By the way, if you don't know anything about those, check out the previous episodes. Give us a call. Our team can help you set these up. They're relatively crazy on how much money you can amass. But let's assume we have that, and you are perhaps in the largest or the most heavy tax bracket. In fact, let's say that you're in a 27% effective tax rate, which means that you've gone through all the brackets and now the total pile of money you make is taxed at about 27%. That's not an unusual story. I see that probably 5 or 6 times a week from business owners who contact us. But let's assume you're in a 27% effective tax bracket, and by investing money into your retirement account, you could reduce your effective tax rate down to 15%. Thus, by paying yourself first, by diversifying your funds away from your business, and by putting them into a retirement account that's properly designed for you, you could effectively remove the 27% tax burden you had on all the money that you put into the retirement account, and you could further reduce the overall tax bill of the money you didn't put into the retirement account by 12% or so. I have a hard time seeing that type of ROI by returning all the money into our business. That's an amazing ROI. In fact, I've seen the reduction of taxes through proper investing provide an instant 30 to 70% of return just because of the tax effect. So I wanted to pause today on this 200th episode and just do a quick teaching, kind of reminisce, if we will, and remind us that we business owners are sitting on an unbelievable asset, our business. Unbelievable. It's a highly illiquid asset, though. And in order for us to liquidate it, we statistically only have a 3% chance of liquidating it. 3%. Highly improbable. And as such, if we can learn to invest outside of our business, especially in a tax-efficient manner, we could, just maybe, we could position ourselves where we're getting an instant return on our investment because of the tax savings of diversification outside of our business that makes even our business investment seem poor. If you don't know how to do this, or if you've not heard of things like this, you desperately need a true planning team at your disposal. Man, I'm happy to report to you that we just opened the company back up and taking clients on again. For a while there, we were at capacity. We've teamed up. We've got some more advisors coming on board. We met with an advisor who's joining us that has a master's degree in forensic accounting. Yeah. Worked at one of the big, large firms and is going to be joining our firm sometime in the early part of next year. We're excited about it. We got some high-quality advisors coming on board. If you need help, reach out and let us know. Hey, look, as always, you can find out the information for today's show on financiallysimple.com. While you're there, make sure you sign up for the newsletter. Man, we're rocking it. We're getting more comments just about on our newsletter, the content we place out there. Some of the best writing I do goes on the newsletter. Look, I say it every week. Life is hard. It is. I get that it's hard to trust people with our money. I do. Trust me, I do. But life is good. And life can be frustrating, no doubt. Life can be frustrating. Money doesn't have to be. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day.